everyone. My name's Ria and Bhutoria, and I'm the Director of Research at Fidelity Digital Assets. We're super thrilled that you could join us today. I'm joined as always by Tom Jessop, the President of Fidelity Digital Assets, and our special guest, Jurrien, who's the Director of Macro in Fidelity Investments Asset Allocation Research Team. For those of you who don't know, Jurrien specializes in asset allocation and global macro strategy in his role, which he's held since 2005. He generates market strategy and investment perspectives for Fidelity clients and the media based on his analysis of market trends. Jurrien is a spokesperson for Fidelity and is a frequent guest on media outlets like CNBC, Bloomberg, and Fox Business News. Jurrien's held multiple roles at Fidelity for 25 years, and he's been in the industry for 35 years. And prior to joining Fidelity, he was Vice President of Fixed Income at ABN AMRO Bank. We're extremely lucky to have Jurrien on our fourth edition of the Value Exchange today to discuss his research report, Understanding Bitcoin. While we've shared research insights and thought leadership on Bitcoin from within Fidelity Digital Assets, this is the first piece that Jurrien has published on Bitcoin, and the importance that it's from someone with a background as impressive as his really can't be understated. Jurrien addresses many questions in this piece, which you can actually find at go.fidelitydigitalassets.com/understandingbitcoin. And the piece is also available in the handout section of the webcast platform. In the report, Jurrien discusses the macroeconomic backdrop that's driving interest in assets like Bitcoin, its unique supply and demand characteristics, different analysis and valuation methodologies, as well as Bitcoin's role in a portfolio. He brings a really unique lens and immense knowledge and perspective of different macro and market regimes to this analysis, and we're really excited for him to share his takeaways in depth with us today. We'll save 15 minutes at the end for audience Q&A, so feel free to share your questions through the Q&A box within the video platform during the event. So Jurrien, just to level set for the audience, could you give us your view on the macro environment today and where you think it's heading?
Yes, well, good afternoon, Ria, and to all of you attending. So, needless to say, and this has certainly been part of the narrative around Bitcoin over the last year, but needless to say, we're living sort of in a brave new world of fiscal and monetary coordination, whether it's covert or overt. Things are happening or have been happening that a year ago, February of 2020, right before the pandemic hit, we were discussing among my group in global asset allocation things about fiscal monetary coordination and MMT, and they all kind of seemed very abstract, and well, maybe someday we'll get there. And then all of a sudden, the COVID pandemic hit, and literally within weeks, we were actually living this in real time. So massive fiscal expansion. If you add the 1.9 trillion that we're about to get next month from the Biden administration, we will have had a fiscal expansion just in the last 12 months of over $5 trillion on a $21 trillion economy. That obviously is a very, very large increase. And that 5 trillion will have been, or at least the 3 trillion so far, has been completely absorbed by the Fed. So the Fed has bought assets to about the same extent that the Treasury has issued debt. And so that coordination between the fiscal and the monetary policy is something that we just haven't really seen since the 1940s, when the U.S. was entering World War II, and the debt to GDP expanded, threefold, all of which was monetized by the Fed, which expanded its balance sheet tenfold and kept rates well below the inflation rate for most of that decade. So what we're seeing today in terms of interest rate policy, QE, fiscal expansion, debt increases, you have to go back, 80 years to see a comparable period. And so, this has been a catalyst for the Bitcoin story, with Bitcoin being the protagonist in that story. So everything kind of came together in 2020 as far as that whole setup.
Thanks, Jurrien. That's super helpful. One thing that I wanted to ask as a follow-up to that is something that I was asked towards the end of 2020, and I thought you'd be the perfect person to get a take on this, but do you think what started in 2020 and is continuing today as a result of COVID, does it represent a fundamental or paradigm shift in terms of the macro environment? Or do you think that it was an acceleration of a shift that was already underway?
It's an acceleration. So it started with the financial crisis. So that was a time where, obviously, during the GFC, there were large deficits, about 10% of GDP for 2 years in a row, 08 and 09. The Fed essentially did the same thing. It absorbed those deficits by doing QE and dropping rates to zero. But that's kind of where the parallel ends, because then we had the Tea Party movement that actually created some fiscal austerity. So those deficits went back down to about 3% of GDP, just as at a time when the Fed was adding about $3 trillion of assets to its balance sheet. And that kind of highlights what normally would happen. So the fiscal and the monetary side normally are not going hand in hand. So if you have fiscal accommodation, maybe the Fed leans into that or leans against that. As the old saying goes, the Fed takes the punch bowl away just as the party gets started. Mm-hmm. And so the Fed, as an independent central bank that wants to curtail inflation risk, would lean against that. And that's actually what the Fed did in 2017 during the Trump tax cuts. The Fed was normalizing policy. So usually the two pendulums are not going in the same direction. The one time, or not the one time, but one of the few times that they did move in the same directions was during the GFC, but only for a couple of years. And of course, as I mentioned, the 1940s, which to me is a very important analog to what we're seeing today. So we had the GFC, we had that double-barreled approach to policy, but then things normalized. And now we have, of course, COVID, the pandemic, and at this point, the debt to GDP, which was already at around 100%. During World War II, it was 116%. That debt to GDP is now rising rapidly. It's already at 120, probably going to 130 or 140. And what's different now, between now and then, is that the demographic backdrop is completely different. So after World War II, the US was able to grow out of its debt burden, as well as inflate. Because we had the baby boom, the U.S. was rebuilding the world, et cetera, et cetera. We don't really have that right now. The spending that's happening now is really there to fill a gap, left behind from the pandemic and the lockdowns. Demographically, it's going to be much harder to grow out of this debt in the years ahead. And that basically requires inflation or debasement as the way out. And that is what the Bitcoin story, as well as other cryptocurrencies, is really about right now, is I think, the Bitcoin crowd sees that we're going to need to have negative real rates for quite a long time to ease the debt burden. And that's, what brings gold into the mix. It brings Bitcoin into the mix, which in my view is a form of digital gold. And so the GFC was the paradigm shift, but it was kind of mean reverting for a while, and now we're going in a whole new direction. And there's only two periods in time where we've seen the kind of fiscal monetary expansion that we're currently seeing, and they were World War II and the Civil War. So that shows you how rarefied the current scenario is in terms of policy.
That's great, Jurrien. So you pretty much laid out the case for why we could see consumer price inflation and why this time around is really different from what we saw during and after the global financial crisis. But you've also, in some of your writing and in our conversations, highlighted this case of Japan as a conundrum with significant debt, but no inflation or currency devaluation. How do you think about the likelihood of either situation playing out here, and what are the risks to either situation?
Yeah, no, it's a great question. And to me, the experience in Japan is a cautionary tale against an extreme tail event happening, which would be, and we see this, we hear this very often if you go on Twitter and you kind of read what the really hardcore crypto people are saying. This notion that the U.S. is going to run the dollar into oblivion, and we're going to get hyperinflation and a new world order, a new monetary world order. It's possible, but the experience in Japan tells us that it doesn't have to end that way, right? So, and just to give you an example, Japan is ahead of the U.S. in terms of its demographic curve. So, what the U.S. is experiencing now in terms of demographic, the age wave rolling over, labor force shrinking. It's not quite shrinking in the U.S. yet, but it's slowing. Japan was there 10, 15 years ago because it's kind of ahead of the global curve on demographics. And of course, Japan, as we all know, has had zero to negative interest rates, lots and lots of debt monetization, high deficits, which were monetized by the central bank. And just to give you an example, since the GFC alone, the debt to GDP in Japan has gone up by 100 percentage points. Okay, that's like the US going from 100% to 200%. I mean, it's an enormous increase in debt. And the Bank of Japan has monetized all 100 percentage points of that debt. So the Bank of Japan's balance sheet relative to GDP went from about 30% to 130%. And yet the 5-year annualized inflation rate in Japan is zero, and the yen is extremely stable. So, the notion that what we're seeing on the fiscal and monetary side in the U.S. is automatically going to lead to a collapsing dollar, the end of the world reserve system, dominated obviously by the U.S. dollar and or hyperinflation. That is not a foregone conclusion at all in my mind, because in Japan, that's not what happened at all. And it tells me that the deflationary forces of demographics are very powerful, and we're seeing that in the U.S. So I think we'll get cyclical inflation because as the economy reopens and things get back to life, you have these low base effects in the CPI. So we're going to definitely or likely going to get some inflation, but whether that inflation becomes structural, to me is unclear. And of course, we have to make the distinction between inflation in the real economy and monetary inflation. And I think, when you look at gold back in the 70s, that was a hedge against actual, inflation measured by the CPI. If you look at what's happening in Bitcoin, it has much less to do with real economy inflation or goods inflation or service inflation, but much more with monetary inflation. And I think that's how it's seen as a hedge. So again, it's just important to see all sides of the story here. And if we don't get this hyperinflationary currency collapse, it doesn't take away the value proposition of Bitcoin at all. It's just that I'm not willing to go to the extremes that sometimes we see talked about.
Jurrien, maybe to jump in here and pick up on this concept of, I think you mentioned earlier, I think it's widely recognized that the Fed and other central banks need to keep interest rates low, just given the debt load we're carrying. The practical effect of interest rates going up is pretty significant. I was reading something, I don't know if this is tongue in cheek or real, but every 50 basis point increase in the borrowing rate to the government is equivalent to the annual budget of the US Navy. So it's very clear that we need to keep rates low. But at the same time, we've seen recently that yields have picked up a little bit. And it harkens back to, I had seen this term bond vigilantes come up recently. And I said, I know that from somewhere. And I did a little research. And in fact, you had a period of about 12 months in the early 90s where the 10-year yield went from 5% to 8% in less than a year. And it was attributed to these, quote, bond vigilantes, which I guess is a euphemism for the bond market, basically saying, we're not going to take this anymore. And I'm just wondering, how do we reconcile just the push-pull of needing to keep rates low, but investors having a view and actually having some influence on that equation? What is the risk of something like that happening again? Or do you think that through Fed policy, they have an ability to control where rates are for an extended period of time?
Yeah, no, it's a great question, Tom. And really the critical variable in the rates market is our real rates, right? So rates have been rising for almost a year since we formed the bottom in the markets in late March of last year. But they've been rising as inflation expectations have gone up, which is a good sign. That's part of the reflationary narrative or playbook, if you will. So rates going up, nominal rates going up on the back of rising inflation expectations. The Fed wants to see that. I mean, the market wants to see that because it means that things are getting better. But what's happened in the last few weeks is that inflation expectations actually started coming down, or at least not moving up anymore, and real yields started to move up, and real yields are up about 50 basis points from their lows about a month ago. And rising real yields, when you have this much debt that needs to be serviced, and the economy still running well below potential, right? So the unemployment rate is about 2 percentage points above what the Fed considers to be the natural rate of unemployment. So that is kind of how you can measure the output gap. Another way of showing it is to look at actual GDP growth relative to potential growth, which is the sum of productivity growth and labor force growth. There, the gap is around 3% still. And on the unemployment side, it's about 2 percentage points. So both the Treasury and the Fed, I think, are intent on letting the economy run hot in order to close that gap. And I think even on top of that, right now, I think both monetary and fiscal policy are maybe not directly or overtly, but they're kind of run almost with an ESG kind of framework in mind, where they don't just want the overall U3 unemployment rate to go back to capacity, but basically the unemployment rate for all segments of the population. And so the market is kind of sniffing this out, and the market's looking at 1.9 trillion of more fiscal coming at a time when the COVID curve really is coming down very, very sharply. If you look at the percentage of hospital beds being occupied by COVID patients in the US, it was about 20% a month ago. It's down to about 8% today. So the curve is really coming down. And so the notion all of a sudden is that the economy is going to absolutely boom in the second half, and the Fed is going to just keep the spigots open in order to prevent the market from pricing in rate hikes, which then feed into real rates, a rising term premium. It's a very delicate dance that the Fed and the markets are now doing, because an economy that has 120% debt to GDP and rising, and a market that is kind of levered to very low rates, right? The S&P is a lot growthier than it was maybe 10 years ago, or even 5 years ago, certainly in 2013 when we had the original taper tantrum, if you will, when real rates jumped by almost 200 basis points in 6 weeks. Market's much growthier now, and these long duration growth stocks are much more sensitive to a change in interest rates than a more kind of value tilted market. So, the effects, we saw this last week, real yields jumped 20, 30 basis points, and you saw the fangs kind of really roll over. So the real yield is really where it's at. And I think the Fed is going to be doing whatever it needs to keep those real yields hopefully negative. And you can do that by repressing rates down towards zero. But ultimately, you're going to need actual inflation to get you there. And I think that is kind of the new race to the bottom among highly indebted countries. It used to be get your currency down, get your rates down. But at this point, with rates already down, I think it becomes a race to inflation, because if you can't grow your way out of debt, you're going to need to inflate your way out of debt.
Jurrien, I think you pretty much laid out why you started looking at Bitcoin now, why this was your aha moment. Before we get into the meat of your piece, as you were looking at Bitcoin, what did you find to be the most enticing attributes? Do you think we should start, be classifying Bitcoin as a store of value? And what else do we need to kind of deem it as such?
Yeah, so you know, I never really thought. So anyway, so the Bitcoin story, of course, has been unfolding for about a decade, and you know, in 2017 when it went to 20,000, and then it fell, you know, 80-90% to 3,000. I, like many probably other casual observers, would think, you know, okay, that was a bubble, it's gone, you know, on to the next story. And then it kind of crawled its way back. And then in 2020, again, we had this perfect storm of both a catalyst in terms of kind of MMT light, if you will, and then the protagonist of the story being like right there. And then you got adoption by very respectable institutions, and that kind of reached a critical mass where, you know, where we got to the point where, like, one of the things that I always struggled with is like, this is an unknown value proposition, which is, of course, is why you have price discovery, because if it was known, there would be no price discovery left. You know, Bitcoin would just trade where it's supposed to trade, and that would be the end of the story. But just like gold in the 70s, there's this price discovery process where not everyone is on board, not everyone knows exactly where things should be, and so that's how the story unfolds. And at this point, it seems like we have enough critical mass, even to the point where holders of Bitcoin can essentially borrow and earn a carry on Bitcoin, which of course is another criticism or another. You know, another reason to not buy into it early, just like gold, because gold and Bitcoin don't produce a cash flow. So then you can't value it in a discounted cash flow type of way, which is, of course, which you can do for bonds and equities. And bonds and equities compound, and gold and Bitcoin do not, because they don't generate a cash flow. So there were all these reasons not to kind of be bothered by it. But, you know, as a global macro strategist, it bubbles up to the surface, and I don't mean bubble in a negative way, but it kind of goes up to the surface, and then you can't ignore it anymore. And I think 2020 was the year for me, but for many, many other people, where the story can just no longer be ignored. And then, you know, I went down the rabbit hole with your help, by the way, because I didn't really know where to go. If you go on crypto Twitter, you tend to get a lot of echo chambery type of opinion. So it's hard to know what's real and what's hype. But, you know, I got into the whole thing about, you know, the supply curve, you know, stock to flow, obviously a very popular and well-known way to look at the supply side. But the supply side only gets you so far, right? Because you can have scarce supply, but if there's no value in the asset, then it doesn't matter how scarce the supply is. And so that was half of the battle. And then the demand side, you know, Metcalfe's law, this whole network effect, you know, exponential growth curves. That was a really fun way to look at it as well. And I've looked at S-curves for my whole career. You know, even 20 years ago, I created an S-curve to look at where China's economy ranked up to developed countries as they reach industrialization, and how that affects their per capita GDP. And it's in exactly the same kind of S-curve that you would see on, you know, mobile phone adoption and internet subscriptions and things like that. And so it has both the supply and this demand dynamic, and that creates a whole different value proposition, for instance, as it does for gold, which is really obviously a store of value. And you know, I would put gold and Bitcoin kind of in the same place in that sense, but Bitcoin seems to be a more convex version of gold because it has that network characteristic, and it actually has scarcer supply dynamics than gold. So the stock to flow ratio for gold is around 60. So it takes 60 years to replace the stock. But that ratio has been fairly constant. So the incremental supply of gold is fairly constant over time relative to the amount of gold that there is, you know, above ground. Whereas, as we know, for Bitcoin, it accelerated very rapidly early on, but now it becomes asymptotic. And so Bitcoin is actually scarcer than gold, while it also has this demand function. And so that kind of was the main takeaway. And it's interesting because Bitcoin, I view it, or I viewed it when I did this work, as a very futuristic asset class, still going through price discovery. And we see the volatility. We've had a 10-year run interspersed with 80 to 90% drawdown. So it's not a calm ride. You need to have a pretty good stomach. But it's that whole dimension of how do you measure a futuristic asset, and you measure it by actually going way back in history and looking at asset class returns and what gold has meant as a store of value. And, I dug up charts that go back to the year 1200 to show gold as an inflation hedge. And I created a return series for stocks, bonds, and gold going back to 1700. And just to give you one little stat, which is not really relevant to us because nobody was around in 1700, but a dollar of fiat currency would be worth 2 cents today, right? So that's your monetary inflation over time, or the value of the CPI in 1700 would be 65 today. A dollar of gold would be 95 today. But a dollar of S&P, there was no S&P back then, but I strung together a series of equity returns. But a dollar of equities in 1700 would be worth $4 billion today. So that's the whole compound nature. So it was really interesting to kind of go down that rabbit hole and really see how that works. And, gold was essentially just money until 1970, 1971, right? So gold did exactly the same thing as the CPI did, because it was just money and it wasn't really anything else. It was a store of value to protect against inflation. But then when the US abandoned the Bretton Woods monetary system in 1971, and gold was free to have its own moment of price discovery, since that time, gold has become very competitive with bonds, not so competitive against equities, but more against bonds. And then now, if you view Bitcoin as a form of digital gold, which is how I view it, I don't view it as a medium of exchange, because I don't know why anyone would ever exchange a scarce asset to go buy a cup of coffee. And we know the story about the guy who bought pizzas 10 years ago, and the pizzas would be worth $40,000 or something like that. So I view it really as a store of value, and I view it against gold as a hedge against really monetary inflation at this point.
Jurrien, one quick thing on the gold comparison, because obviously, and you alluded to this, and we are well aware that Bitcoin's volatility sort of disqualifies it as a store of value. And in fact, Ria has been very careful in her research to call it an aspirational store of value. But coming back to this historical comparison, can you just spend 30 seconds talking about the post-Bretton Woods volatility of gold and the fact that it looked a lot like an adolescent asset class, or an asset class looking for a specific application, much the same way that Bitcoin does today?
Yeah, no, absolutely. And if you overlay, and this is actually a really interesting overlay. It's not in the report because I did this since the report was published, but I'll probably post this on Twitter at some point. So maybe you can find it there. But if you look at the price action, the price discovery of Bitcoin since 2010, and you overlay that against the price of gold since 1970, you can see a very compelling overlay. Now, the order of magnitude is not the same because, like I said, Bitcoin has a whole different convexity characteristic as gold. But in terms of the moves up and then corrections and then another move up, it looks very, very similar to what gold's discovery process was like during the 70s. So I'm using that kind of more tactically now in terms of getting a sense of, how much is too much right now. Like we know from the stock to flow model that the terminal value for Bitcoin out 5 years or so, when the supply curve has really leveled out, is far, far higher than where it is today. I mean, that's not a prediction, but that's just what the stock to flow model suggests. I mean, I reverse engineered the one that's out in the internet by Plan B, who kind of really pioneered the whole stock to flow. I have a much simpler version. I mean, all you have to do really is invert the the growth rate of supply, which of course we know into the future because of the way that the supply curve was designed. So if you turn that supply curve upside down, regress it against the Bitcoin price, in 2025 you get a value of about 450,000. The value predicted for 2020 was 25,000, which we pretty much got to exactly on the nose. So I'm using that kind of projected value and I compare it to where Bitcoin is and to see how it deviates or follows that. And of course, in the last couple of months, Bitcoin has gone up a lot, far more than at this point than the supply curve would suggest, right? Because my version of the stock to flow has about 60,000 as the year-ending fair value, if you will, for 2021, and we already got there, in February, right? So maybe it's a little ahead of itself from that perspective. And the same thing with that gold overlay for the 70s follows the stock to flow model very closely, but again, we kind of front ran a lot of that early. And so it's not surprising to me to see that Bitcoin actually is now consolidating. I think we went down as far as 45 or 44,000 earlier this week or last week, after going as high as 58,000. So, Bitcoin follows these parabolic moves, and then you get the halving in supply, and then it kind of consolidates for a while. And it wouldn't surprise me if it did that now. And I think actually I would welcome that. As someone who's looked at charts for 35 years. You don't want any market, whether it's stocks or bonds or anything, going up too much too soon, because then you get very large dislocations. And as you mentioned, Tom, the volatility of these 80% drawdowns that we've seen twice in its 10-year history, my guess is, and it's just a guess, is that we won't see those drawdowns be as bad in the future, just because we're getting far more institutional adoption, and there's going to be far more people, I think, that will look at any decline in price and say, this could be my chance to get in. So my guess is that the volatility framework will start to improve. But as that improves, the upside potential probably gets more orderly as well. And I think a lot of institutional investors would actually welcome that. I think they would welcome less upside, but also fewer drawdowns or smaller drawdowns.
Jurrien, I think one thing that you did really well in your piece is just present like a really balanced view. And, you did a great job highlighting the limitations and the merits of all the models that you discussed. Could you talk a little bit about, what are your thoughts on the limitations of both applying stock to flow and Metcalfe's law to an asset like Bitcoin? And then I have a follow-up question after that.
So for me, again, you go on crypto Twitter, and you see some fairly wild value cases there, and again, the notion that you got to be irresponsibly long Bitcoin and other cryptocurrencies because the U.S. is going to destroy the dollar, and we're kind of getting into the next chapter. We had the gold standard, then we had the Bretton Woods system, and now we have the fiat system since 1971. And then the next phase is going to be a collapse of fiat currencies and a return to some kind of gold or digital standard. I'm just not prepared to go there. And again, because we've been on a fiat standard for years. We had a massive run up in debt during the 1940s that was completely monetized by the Fed. The Fed engineered very negative rates. It expanded its balance sheet tenfold, and there were, and the outcome was still positive. Of course, it was positive in part because the U.S. was able to grow out of that debt. But the notion that this is a slippery slope that is going to only end in a complete destruction of the financial system, I mean, that might happen. That has happened to some countries. But the U.S. as the dominant reserve currency, I'm just not prepared to conclude that. And of course, as you asked about earlier, the experience in Japan shows us that even in the modern era, a country that has aging demographics and deflationary headwinds, just as the U.S. has had. Remember, the Fed has not been able to achieve its 2% inflation target for over a decade now. It shows that even if you run up your debt in an unsustainable or irresponsible way and you monetize all of it, even then, it's not a foregone conclusion that the currency destabilizes or inflation accelerates. So I'm going to be agnostic on that side. But the good part is I don't need to believe in that extreme outcome to believe in either gold and or Bitcoin as a store of value, as a hedge against ongoing monetary inflation. And gold is a pure play on negative real rates. I mean, if you look at the TIPS 10-year real yield and you flip it upside down, it explains perfectly what gold has done. And so, like I said earlier, the Fed needs to be able to engineer negative real rates by keeping rates very low, possibly through yield curve control if it needs to, and I suspect that it will need to, but then B, to still have inflation go up so that you can engineer those negative real rates. So that's the value proposition for gold. And then Bitcoin kind of plays into that, but as a more convex version of it. So that to me is kind of a way to temper the otherwise unbridled enthusiasm that we might feel for it. And the other way I look at it is, most of us look at the world through a 60-40 lens, right? I mean, we're all kind of, if we're investment advisors or we're running, balanced portfolios as we do at Fidelity, 60-40 is kind of the paradigm through which we look at things. And then the question is, where does Bitcoin belong? Where does gold belong? Where do inflation hedges belong? And as I demonstrate in the paper, I think pretty convincingly, because the data backs it up, I don't really want to mess with the 60 part of a portfolio because equities are a proven store of value. They are an inflation hedge, maybe not a hyperinflation hedge, but I don't really want to go into that extreme tail event, but they're an inflation hedge and they compound, which is something that gold and Bitcoin cannot do, because they don't generate a cash flow. So the 60 part, I'm going to leave alone. But the 40 part, normally I would leave that alone too, because bonds have actually a pretty consistent track record in producing 5% annualized returns. But right now, with bond yields so low, and not just the Fed, but countries around the world that have too much debt, really needing to create negative real rates, the opportunity cost of owning gold or Bitcoin or TIPS for that matter, instead of regular nominal bonds, that opportunity cost is very low right now because yields are so low. And as yields fall, the forward return potential for bonds falls as well, because generally if you buy a 10-year bond at 2%, you're going to get a CAGR of 2% for that bond. And so that's kind of how I look at the value proposition right now as we look at markets and how they've unfolded.
Jurrien, I thought that part of your piece was an especially interesting analysis, because a lot of similar analyses that we've seen on including Bitcoin in a 60-40 usually take equally from both buckets and don't have this discussion of which assets are important in different inflationary regimes. And I think in your writing, you specifically said that equities do really well when inflation is in the 2 to 4% range. So I thought that was a great insight. Just continuing this conversation of portfolio allocation, a lot of these analyses also talk about, implementing a strategy of rebalancing given Bitcoin's volatility. I know that the answer probably differs from one investor to another, but how should investors think about applying a rebalancing rule to a Bitcoin investment?
I mean, I'm a strong believer in rebalancing portfolios, either on a kind of a calendar year basis. If it's your birthday, might as well use that as an opportunity to rebalance. And I'm not speaking specifically about Bitcoin, but just a portfolio in general. My mantra for long-term investing has always been the same, which is have a plan, a plan that makes sense for you. And I'm talking about a traditional kind of 60-40 paradigm here. And then stick with the plan because, markets don't always go where you want them to go. And in fact, the stock market is in a 10% correction about 40% of the time. So the markets can and will go against you. And then, you have to have the discipline and the detachment to say, you know what, I'm going to trust the process and I'm not going to get carried away and end up, doing something I shouldn't be doing, which for a lot of investors is selling at the bottom. And then the third one is rebalancing to your question. And rebalancing should happen, regularly, whether it's every quarter or every year, but it also should rebalance based on large moves. So for instance, last year, and again, I'm not speaking about Bitcoin right now, but a year ago on the equity side, a 60-40 portfolio in February prior to COVID would have turned into a 50-50 portfolio 1 month later at the bottom of the COVID crash. That may not sound like a lot, but that's a 10 percentage point swings without having to do anything, without actually touching the portfolio. And what happens is from that 50-50 point on, as the market recovers, which of course it did, you're compounding a 50-50 portfolio rather than the original 60-40. So when you have big swings, I think it's important to rebalance as well at that point, because whatever you think was the appropriate asset allocation before something big happens, it should still be the same. And I think we can extrapolate that experience to Bitcoin. If you put in 1% of your portfolio and it becomes 5%, well, I mean, that's obviously a luxury problem. That means you've done something right. But at that point, if Bitcoin goes down, 50%, that's coming from the 5%, not from the original 1%. So It's a little bit of a question of you buy it for growth and it grows and that's great and maybe you let it run. But if you're buying it for diversification or to amplify your return while diversifying your portfolio and having that store of value, I think it's important to probably continue to rebalance. And I just wanted to put a few numbers on this notion of how much should you own, right? I mean, nobody has the right answer to that. I've heard 1% to 3% as kind of the range of how much you might want to own. And again, it's going to be different for everyone because people have different risk budgets. And obviously, the more of a volatile asset class you have in a portfolio, whether it's a 60-40 portfolio or if you're a corporate treasurer, maybe it's a kind of an intermediate bond portfolio, it's going to affect your tracking error and that's going to obviously move the needle. But, I just ran some numbers, this morning, and in a 60-40 portfolio, so 60% S&P 500, 40% Barclays Ag, over the last 10 years, if you had 1% Bitcoin at the expense of the 40, again, as we were talking about earlier, I don't want to touch the 60 because the stock market is a proven source of growth and inflation protection. But a 1% allocation over the last 10 years would have increased the CAGR, the compound annual growth rate, by 2 percentage points while increasing the vol by only 0.1%. Okay, that's a pretty compelling risk reward. Now, obviously, that 10 years saw an astronomical increase in price, but also an astronomical volatility. But to me, I was actually a little bit surprised by how good the numbers actually stack up. It's not like you're getting double the return for triple the volatility. You're getting several hundred basis points of additional return for a reasonably modest increase in vol.
Yeah, no, I totally agree. We did a similar analysis, and going back to the rebalancing point, I think we set up a portfolio with 1% to 3% Bitcoin in January 2018, and if you had rebalanced regularly and held it through September 2020, it would have still the returns would have still been modestly higher than a portfolio without Bitcoin. And that kind of just shows you the power of rebalancing. So I think, we're at a good point right now to kick it over to audience Q&A. I'm sure that, there are a lot of questions for you. So I think Rebecca or Chris, I'll pass it over to you.
Thanks, Ria. Our first question asks, there's no doubt that a major driver of the recent run-up in Bitcoin's value has been recent institutional investor adoption of digital assets. Can you comment on the use of electricity by Bitcoin miners, and will that have an impact on long-term institutional demand for Bitcoin?
I mean, it's obviously that is the question that I've certainly been seeing come up recently, and maybe I will defer to Tom and Ria to answer that. But the notion of whether Bitcoin is ESG friendly or anti-ESG is certainly one that's making the rounds, and I think Tom and Ria are far better equipped to answer that. If you don't mind me, handing it over.
Ria, just given that you read a report year-round about misconceptions around Bitcoin, one of which was energy consumption, why don't you share some of that with the audience?
Sure. This is definitely a really common question, and I think the first kind of line of defense or kind of pushback that we have against this is if you look at Bitcoin's energy consumption and you look at what portion of it is actually powered by renewable resources or by trapped resources that would otherwise be flared or vented, I think the estimates range from about 40% to up to 73%. And Bitcoin is also really unique in that it's mining is kind of agnostic to population centers. So it can leverage resources that are, far away from population centers, that are clean energy, renewable resources that otherwise wouldn't be used for anything else. I think the other question is determining whether mining global fixed supply asset that can be transferred peer to peer without any intermediary is a valid use of energy. If you think the answer is yes, then I think that kind of addresses that question in a good way. And I think that the growth of Bitcoin and the increased attention on it will also motivate different players in the industry to determine how we can continue to transition the mining of Bitcoin to other renewable energy sources. One example is, I think Square, has been really involved in the industry in many ways. Last year, they launched a mining initiative or an initiative to power Bitcoin mining and fund operations that leverage renewable sources. So I think we'll continue to see that trend in a positive direction.
All right, the next question is for Tom. What options exist for investors to add Bitcoin exposure to their portfolios? How would an intermediary operationalize a Bitcoin exposure for their clients?
I would say there's two primary ways. One is direct ownership and custody of Bitcoin and digital assets, which is something Fidelity does. The other path is to get exposure to these assets through a fund structure. Fidelity also offers a private fund in the space. There are other companies doing the same. And the third option would be there's a small but growing number of publicly listed or technically OTC listed trust products that trade on stock exchanges that have certain unique characteristics in terms of their premium or discount to NAV. But that would be a third option. And I would say that this entire space is developing quite quickly. And certainly one of the things that we're focused on at Fidelity is making sure that we can bring this asset class to traditional institutions with, in the form factor and with the same sort of artifacts as they're used to in trading other types of assets globally. So there are a couple of options, and the good news is that the range of options is increasing dramatically given the step up in interest.
Great. Our next question, can Bitcoin be replaced by other new technology, and what makes it unique compared to other digital assets?
Ria, do you want to take that one?
Sure, I can kick it off. So, this is another question that comes up a lot is what is Bitcoin's competitive advantage? Bitcoin, if you compare it to the market, it was the first digital asset to emerge and introduce, the entire world to this concept of blockchain technology and the ability to disintermediate a number of functions. It's the only, really fixed supply asset. And one of its key characteristics it does have this first mover advantage. It has seen significant network effects and adoption, and its community has agreed that the trade-offs that it makes make it really valuable relative to some of the other alternatives that try and improve upon certain trade-offs it makes, but at the cost of other really key valuable features of Bitcoin. So if you compare Bitcoin to, certain forks of it, and seen how they've played out in terms of the share of market cap, the share of hash rate, the share of network participants, the share of institutional providers that support an asset like Bitcoin, it's really differentiated from all of those because of these network effects, because the market has deemed that the trade-offs that it makes are really valuable. And I think that's what really differentiates Bitcoin and has allowed it to maintain its position as a dominant digital asset and digital asset network.
Jurrien, do you have any perspective? I mean, I know you've thought about Bitcoin in the context of other assets, but relative to other digital assets, in terms of your research, did you do any of that?
I've limited my rabbit hole excursion pretty much to Bitcoin, because otherwise my head would explode, and it was already a fairly steep learning curve as it was. But I can tell you from the perspective of a traditional investor, obviously the supply constraints are critical. I mean, that's the value proposition for gold versus fiat. I mean, money is being like, just since COVID began, the Fed's balance sheet has increased by over $3 trillion. The Treasury debt has increased by over $3 trillion, and you cannot get that in gold, and you cannot get that in Bitcoin. So as a store of value, that's kind of a critical aspect of it. And again, I see it as a store of value, not as a monetary system or a medium of exchange. And I think traditional investors like myself would buy it, only really mostly on that basis. So, that asymptotic supply curve and that hard limit of 21 million coins, and we're at 18.9, I think, at this point, and it's going to take another 100 years just to get the additional couple of million coins. That is an integral part of the value proposition, and I'm not aware that other coins or other digital assets have those same characteristics. I don't believe they do. But even if one was created with those attributes, Bitcoin has already won the race just by being that first mover and getting all that adoption, especially now increasingly by large respected institutions.
Tom, I think you actually had a really good analogy of Bitcoin also versus other digital assets. Bitcoin is really good at what it does, and there are other digital asset networks that are good at what they do. And often, when you compare something like Bitcoin to an asset or network like Ethereum, it's not exactly an apples to apples comparison. And I think yesterday you were saying, it's like comparing equities to fixed income. There is room for both to kind of play a role.
Correct.
Yeah, and I would just add, in the same way that investors will look at silver relative to gold, and there's the gold-silver ratio, and you have physical gold relative to the gold mining stocks, So there's all these relationships, and they all have patterns where they're in a trend, but they mean revert against that trend. I think we can look at Bitcoin in the same way relative to gold, and we might at some point look at other digital assets in the same way relative to Bitcoin. And even if Bitcoin has won the race, as more and more institutions look for exposure, and if Bitcoin has already, let's say, achieved its ultimate price objectives based on stock to flow or what have you, even if other assets enter, we'll be able to kind of value them. They won't be on par with Bitcoin, but maybe they're 10 to 1 or 1 to 10.
Right.
You can run relationships and you can say, okay, well, we're now so many standard deviations below the trend line. And so I suspect that that's where we will go in the coming years. And that's as Bitcoin develops more price history, that's how we will look at it relative to gold. At some point, we know that Bitcoin has been kind of eating gold's lunch lately for the last few months. At some point, you might see a reversal of that, and maybe people will sell Bitcoin and buy gold because gold has gone down too much. But it'll be a band around. It'll be like a standard deviation band around a trend, and I think that's how I would look at future entrants into space.
Great. Ria, the next question is, what is the regulatory landscape like for crypto in the US? Is there a real risk that a regulator could shut down Bitcoin?
Sure. Another common misconception. I think that from a regulatory standpoint, the risk is pretty low right now. There are a number of institutions like Fidelity Digital Assets that are regulated and able to offer services around Bitcoin. The CFTC has deemed Bitcoin a commodity and regulates, futures exchanges that offer exposure to Bitcoin. And now in both the SEC and the CFTC, we have leaders that have a really strong understanding of an asset like Bitcoin, have studied it immensely, have deemed it a valuable and kind of game-changing asset for the industry. So I think the regulatory risk is pretty low around an asset like Bitcoin today. Tom, is there anything you'd add?
No, I think that that's right. And I think we're seeing more positive momentum. Obviously, there was some news from the OCC in Q4 of last year, which clarified the role that banks could play, not only in custodying these assets, but participating on blockchain networks. So we think it's generally positive. I will say this question about, could a government cut Bitcoin off or shut down the network? It's actually a question we've heard more recently. And perhaps that is on the basis or the back of more public discussion from folks like Janet Yellen or Christine Lagarde, other more public discussions about, as Bitcoin becomes more prominent in terms of interest, some of those public figures talking about it often in not the most positive terms. But having said that, if you were to look at Yellen's comments a few weeks ago, where I think the headline was something around energy consumption, the text of her comments was actually quite constructive around blockchain technology. So I think on some of these matters, it pays to read between the lines a little bit.
Yeah, and I would just add to that, when I think about regulation or, confiscation of assets, I always think back to 1933, just at the depths of the Great Depression. The government confiscated people's gold, and then they devalued the dollar by about 40% by changing the price of gold from $20 an ounce to $35. But that's a whole different story because gold was the basis of the gold standard. Bitcoin, I think, may be seen as the basis of a new kind of gold standard, but that's not how the government obviously runs it. And even at about $1 trillion of market cap for Bitcoin, that's still only just a tiny fraction of the complete total global monetary system. So, I don't really see, like when governments get put under pressure or are embarrassed by markets in terms of shining a light on their policy, maybe they'll do something to kind of restrict that. But I really don't see that applying to Bitcoin at all at this point or at any point.
Okay, great. So I think that's all the time that we have for our audience Q&A. Thank you so much for joining us today, Jurrien. It's incredible to have someone of your deep knowledge of macro and markets analyzing an asset like Bitcoin. And we're truly excited to see, how your analysis on Bitcoin continues and on the digital asset ecosystem at large evolves. I highly recommend following Jurrien on Twitter at his handle, TimmerFidelity. You can access our research on our website, fidelitydigitalassets.com, and our research newsletter at go.fidelitydigitalassets.com/sign-up. And then as a reminder, Jurrien's piece is available also at go.fidelitydigitalassets.com/understanding Bitcoin. Thank you everyone for joining us on our 4th value exchange, and we look forward to continuing this series as we share more research and thoughts.